you're watching One News Now Markets. I'm Danny Laurel. Now, before we delve into the equity space, here are the top stories of the hour. S&P Global Ratings has raised its GDP forecast for the Philippines this year, although the credit rater warned that elevated inflation and high interest rates may dampen growth. The credit rater now expects the local economy to expand by 5.8% this 2023. That is faster than its previous forecast of 5.2%. S&P senior economist Vincent Conti said the momentum of domestic demand has stayed stronger for longer than they had expected, prompting them to raise their GDP outlook for 2023. However, the updated forecast remains below the government's growth targets of 6 to 7%. S&P says that while the country benefited from the impact of economic reopening, inflation and policy tightening could weigh on growth later this year and in 2024. Meanwhile, Fitch Solutions expects the Bangko Sentral to continue its policy tightening during its next meeting in May. Fitch Solutions Country Risk and Industry Research anticipates the BSP to hike rates by another 25 basis points in May to 6.5%. Fitch Solutions says this could mark the end of the BSP's monetary tightening cycle. But Finance Chief Ben Diokno, who sits as the member of the Monetary Board, earlier said the Bangko Sentral may implement a pause in May, saying the BSP has, quote, done enough. And just last week, the BSP raised rates by 25 basis points, bringing the benchmark rate to a near 16-year high of 6.25%. And since May of 2022, the central bank has increased rates by 425 basis points, making it one of the most aggressive in Asia. We're almost closing off the first quarter of the year with all of the changes. What is the outlook on the economy now? Here to weigh in, we have with us Jonathan Ravelas, Managing Director, E-Management for Business and Marketing Services. Good morning, Sir Jonathan. Welcome back.
Good morning, Danny.
Sir, I want to hear it from your words regarding this global financial credit crunch, if you can call it that. What is going on? Is this a major recession you're worried about? Is this something that has now been contained and is not going to become a full-blown crisis?
Okay, I think it's more of a contained situation for now. Mainly because I think from the last Fed meeting, we've actually seen how the Fed has really compartmentalized price stability by still raising rates and eventually providing financial stability by adopting certain measures. So far, it seems that the market and the global market seems to have eased on these concerns. So hopefully in the coming months, this should stabilize. The key question really is, how do we all fight inflation? So we continue to expect that the Fed will most likely continue with its hiking rates by at least 25 basis points in the next meeting.
Okay, sir, let's talk about, let's go back to your point on this is contained. Does that mean that in terms of, we just read the growth outlooks being given here by S&P, they're looking at still lower than the government's target. How does this situation during the first quarter of the year offshore impact the Philippines' growth prospects?
Well, basically, I think in terms of growth prospects, we've actually seen that the Philippines, in terms of, despite the high inflation that we've experienced in the past month, the latest fourth quarter numbers of GDP continue to highlight the resilience of consumption. So now that we really benefited from economic reopenings, it's a question of how far will inflation stay on top. So far, we've seen some good signs. One of them is oil prices have really come down. We have seen a very stable peso. So hopefully in the next 1 to 2 months, we can probably conclude that probably inflation may have peaked last January.
Okay, so you're talking about the domestic issues. Can you say with confidence that we are isolated from the other offshore issues at this point? And like you said, inflation, domestic inflation is the key worry here.
Yes, I think what happened in the U.S. is quite different from what happened domestic. I think we have so much liquidity and, where we have more stricter financial stability systems here in the Philippines as compared to the US, no? So that's why it's more of a sentiment-driven play that we've seen bank shares have fallen. But at the same time, if we actually look at the present situation with the rising interest rate, it actually should be very good for banking shares because it actually increases their net margins. No?
Okay, sir, back to the inflation story. Still, and of course, we saw a bit of an easing in the last sprint, but nevertheless, when you look at the core inflation, it's the highest in more than 20 years, as I understand, and the month-to-month still doesn't seem to be easing. Why do you believe that we've already reached the peak? And are you seeing any impact of the rate hikes already coming into play? Because it seems that that lag, when you look at this chart, is taking so long.
Well, what I said, let me clarify, Danny. No? We could have peaked. I didn't say, I'm not a subscriber that we've actually seen the peak.
Okay,
it's just that probably there are certain situations that we've seen so far. One of them is a very stable peso. So coming from 59, we're around 54.25. 54.30. So we were able to hopefully slow down inflation. But an 8.6 inflation is by far still high compared to a upper band of 4%. So we could probably seeing that probably in the first half next year. So that actually depends on further hikes. So despite that, there have been hints of a possible pause, I think policy rates should still move towards 7% if we really want to ensure that we're able to try to bring down inflation closer to 4%.
Okay, so let's push you on that 7% rate. Can we afford that? Can the economy still afford higher rates at this point?
Well, yeah. In 2007, these were the policy rates at that time. So, compared to probably what we've seen in the last 10, 15 years, you have to remember in 2000, we were having double-digit rates.
Okay.
Especially for the long-term rates. No, they were over 10%.
Wow.
Right. They're still below that. We're still just below the 2018 high of 8% for the 10-year rate. So companies in the Philippines, particularly the blue chip companies, are able to sustain this high interest rate. They can absorb this. Even in the 70s and 80s, they were able to do this. So it's only now that we really, in the last 20 years that we've seen the decline in interest rates. And previously on your show, I've highlighted that in the last 2 to 3 years, we've actually seen the reversal of long-term downtrend interest rates. So this is the adjustment that we're seeing.
Sir, Finance Secretary Diokno said that the BSP has done enough in terms of raising rates, and he says they might actually pause. So do you say that maybe not? There's still room here for the BSP to act?
Well, I guess they're looking at the point. They're already assuming that January is a peak.
Okay.
One top doesn't really signal a top. It will take probably 2 to 3 points. And just like what you mentioned, core inflation still at an all-time high. So that is something that has a stronger signal that inflation is not yet finished.
What does this mean for our stocks, sir? Like everything that's been going on. Is the money going to be, risk aversion is going to take hold, and but you mentioned the peso is getting stronger, so that might bring in more people to emerging markets, dollar weaker. Give us an idea of your outlook on the equity space.
Okay, so let's eventually try to put the Philippine economy, now that we've reopened, it's like we're driving our car. Okay, so we moved the stick shift to drive, but eventually we forgot the handbrake given the high interest rate and high inflation environment. But the nice thing about it is that the Philippine economy is quite resilient in consumption. So as long as you have job growth, and we're seeing a lot of signs of the economy moving forward, we could sustain a 6% growth.
Okay.
I'm looking at 6.25% because looking at probably fourth quarter, we will probably see more definite signs that inflation would have peaked in the first half. So this is based on my readings. Now, the other side about it as an investor is really, again, given the global sentiment of a potential recession, investors have to take a very defensive play.
Okay.
So it's really looking at dividend plays at the moment, or staying, sad to say, either stay on dividend yielding stocks or go for short duration government securities.
Okay.
So those are the two things that you can do. But again, if we tend to look at long-term investors who are looking at probably 5-10 years down the road, then definitely you will start looking at, again, number one, telco companies.
Okay.
Because as we try to go for connectivity, it plays an important role now. That even in the property sector, connectivity plays an important role, especially in areas where we have have bad signals.
Okay.
But because of technology, we're able to allow these certain properties to have good communication signals. So it creates value for those properties. So property is another sector. Plus, of course, food and retail will continue to play an important role. So it's really trying to look forward in the sense that the Philippine economy continues to grow. Our recovery is underway. It's just that we're sidelined by this number one, high inflation and high interest rate scenario. But the Philippines in the early 1990s grew despite at around 3-4%, battling double-digit inflation. Now that we're single-digit inflation, the Philippine economy can hack this type of situation.
Okay.
So-
Finally, sir, yeah, before we let you go now, what's your outlook on the earnings, the fundamental bottom line of the companies? We saw in the third and fourth quarters, they surprised on the upside, despite, like you mentioned, 14-year high inflation. Are we going to be seeing the same in the first quarter this year? Are those types of earnings sustainable in 2023?
Well, the first quarter earnings, I think, will be the acid test to ensure if we're really going to probably see 15 to 70% earnings growth this year. Because probably from the previous year, we've seen, we were coming from a low base. So this time, we will be factoring these new realities at this point in time. So this will really be more of probably trying to test whether we're still going to see the high teens or we're just going to stay low teens. So if it's going to be low teens, then probably the situation for the market itself would probably just consolidate between a level of 6.8 and probably towards 6,300 as a range for the index.
Okay, so one thing to be clearly watching out for there, no? Acid test. How did the first quarter earnings come out? Thank you so much for weighing in, Jonathan Ravelas, Managing Director of E-Management for Business and Marketing Services. Thank you, sir.
Thank you for having me. Good morning.
And that's it for this hour. I'm Danny Laurel. Join us again at 11:15 a.m. We are One News, all sides, all the time.